Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US credit and global market engagement at IGM. I'm here with my colleague and co-host, Bruce Clark. Hi. So, head of rates market coverage. Today, we are going to talk about the direction of interest rates in the US and the European Union, two of the largest power bodies in the world, in response to the inflationary pressures from yet to be resolved Iran conflict. Should I say on and off Iran conflict? We'll also talk about the policy stance taken by the new Fed chief, Kevin Warsh, Trump's NATO summit visit, which has geopolitical implications, and what's the outlook for the largest government bond markets in the world. So joining us today to answer all these questions is IGM's head of fixed income strategy research, Marcus Dewsnap.
Hello.
Welcome, Marcus. Welcome.
Hey, Marcus.
Hello. Happy to be here. Thank you for having me.
Good to have
Marcus,
you. Marcus is a thinking man's analyst, unlike myself. So
very kind of you. That
this should be an interesting conversation.
It's not how I'm usually described, but
so Marcus joined IGM in 2010, and he writes primarily about the macroeconomic landscape from both a monetary and fiscal policy viewpoint in the UK, Eurozone, and the US. And I'm told, Marcus, you also worked as a production person in Bloomberg and TV channels, yeah?
I did. I worked at CNBC and Bloomberg TV for around about 10 years or so.
So great, yeah. You're an all-round guy. You've done everything.
Looking at it.
So let me kick it off. So I wanted to start with, basically talking about how government bond markets have actually behaved at the start of the year, right? And what kind of macro expectations were they pricing in at that time? And then we had the Iran conflict. So how did that change? And was there a war premium? Because everyone keeps talking about a war premium. I didn't quite see it in the credit markets that much, but we saw it briefly. And how is it behaving now? Because it seems like this conflict is ongoing. And what are the different ways you should position for this kind of situation, basically? So, Marcus, do you want to kick off and tell us how the European side of things looked like at the start of the year? What were they looking at?
Well, if you looked at bond yields, they were actually heading lower until everything kicked off in the Gulf.
Right.
And if you look at the UK, it was mediocre growth, some political concerns. Bank of England probably more likely to cut rates. The ECB was at neutral,
right,
which is what the markets were pricing for. Again, they were looking at mediocre growth, possibly called resilience, but nothing spectacular at all. The inflation outlooks were fairly okay. Nobody was sort of thinking, wow, we're going to get an explosive situation. Japan was the outlier where yields were heading higher. And this is where we start getting into sort of idiosyncrasies as to what's happened. Japan was heading higher and kept heading higher. And then throughout the last couple of months until the beginning of this week, they were going sideways again. And they got a bit of a boost this week again until this morning, right, when the Japanese finance minister, kindly nudging, I suspect, the domestic pension funds to start having a serious look at buying local assets.
Right.
And of course, there was a JGBs overnight. I mean, they're still pretty high. This is not a major reversal. 10 basis points might sound a major reversal,
Right.
but in the context of how far the yields have risen throughout this year,
Right.
that's not a huge reversal. And of course, Japan's got fiscal, probable fiscal expansionary fiscal coming, and a normalization of interest rates.
Right.
The UK has some idiosyncrasies around its political dimension, and of course, the UK itself also has a current account deficit, and that means it needs to get money from abroad.
Right.
Hedge funds have been fingered as being one of the reasons of creating a bit more volatility in the UK market.
Right.
And as the oil price has gone up and down, so UK yields have generally outperformed or underperformed European peers. And within the UK itself, inflation is a major issue or impactor, in that there's quite a significant portion of UK debt that's index linked.
Right.
You've also got quite a chunk of the UK welfare bill, as in the fiscal space, that's also index linked. So whenever anything changes inflationary, it can have an outsized impact relative to other nations.
Right.
The Eurozone, again, as the ECB was in neutral, but again, there's this inflation fear,
Right.
which is the reactionary function of the ECB has been determined to be, we're probably going to hike, which they did, and that has been kind of pervading the entire yield curve and pushing them up generally higher.
So the UK and the European yields or the markets, were they expecting inflation at the start of the year as well, or did the Iran conflict?
No, nothing. It's generally been the Iran conflict which has kind of induced this reaction,
Right.
and you can see that sort of in the inflation swaps, for instance, are quite an interesting window into this,
Right.
in that they are heavily influenced by oil, and we've had an inverted euro inflation swap curve, which kind of suggests the market is seeing this as fairly short term.
Right.
But the ECB itself are quite scarred from what happened a couple of years ago with the gas crisis, and in fact, if you go back to one of the March ECB press conference, Governor Lagarde did actually specifically say reaction functions of economic agents will be different this time around because they've got kind of shorter institutional memory. You go back to the gas crisis, when was the last really heavy inflationary episode?
Right.
A long time ago. All of a sudden, everybody's going, ooh, crikey, I remember what happened 2 or 3 years ago. So that institutional memory is shorter, and then that creates a different reaction function for economic agents, and that's one of the things that the ECB has been quite concerned about.
Hey, Marcus, refresh my memory. Is the Bank of England and the ECB, are they single mandate central banks, or are they dual mandate like the Fed?
Well, primarily they are inflation mandates.
Okay.
But you go back to Andrew Bailey was at pains to state in one of the meetings this year, we are also here to support growth.
Right.
So you've got to take that into the outlook as well. And this has been this debate in the UK in particular about the inflation growth trade-off going forward, which with the Bank of England was already in restrictive territory when we entered March. It was already a bit concerned about economic growth. So it's all right, everybody's saying, oh, look, inflation is busting through the top end of the sort of 1 to 3% range it's supposed to vary in between. And then, Andrew Bailey says, yeah, but you've got to look at what might happen to economic growth. You can't just go whacking interest rates up purely on the inflation side of matters. You do have to take economic growth into consideration.
Yeah, I remember writing. I remember writing at the time. It was in early May, when oil prices had peaked, and both the UK and Europe were pricing at a bit more than 3 25 basis point interest rate hikes over the balance of the year. And I remember, thinking to myself, these economies are barely growing. I mean, for gosh sakes, I mean, this isn't going to end well, right? If of course, the fact that they're not energy independent regions complicates the issue, right? As oil prices rise. So, anyway, but it seems like it's all. I don't know. I'm curious what you think of the reaction of oil prices this week. You had a resumption of the conflict in Iran, and oil prices popped a little bit, but it's like, and now it's all sort of, draining back off. And, the markets, to me, the markets are not convinced that there's going to be any kind of long-term oil problem.
How
do you see that?
It's all been very contained this week, which I think has surprised quite a few people, given, I suppose there was some quite belligerent statements or underlying belligerence from the ceasefires off, which, I kind of looked at that and I thought, given what President Trump's off the hip kind of comments have been throughout the conflict, was that just another negotiating tactic? Make sure Tehran does stay at the negotiating table through it all. And Tehran itself hasn't really turned around and said a great deal. And that's what the market's interested. There is an underlying core belief, I reckon, that the domestic US political situation is what's dictating the oil market reaction, in that gasoline prices obviously become a big problem politically. And actually President Trump is actually more interested in making sure those get suppressed and pushed down. If you suddenly start lobbing a heck of a lot of missiles around again and possibly shutting off the Strait of Hormuz, he may have said earlier on that he didn't care about the midterms. He might not, but his party does.
Right. What do you, as far as pricing in the interest rate futures markets now, what do you think the U.S. has 1.5 rate hikes priced in by the end of the year? Maybe a little bit less than that. Europe and the UK have a bit more than that. What do you think, comes out of the balance of this year? Is that pricing too high? I personally think in the US that we're probably going to have rates stay unchanged for the balance of the year.
So actually, Marcus, before you answer that, one question I wanted to ask are these central banks, like what Bruce was saying earlier about, they had priced in hikes, 1 or 2 hikes early in the year, and then there was these hikes. Like, do you think the central bank should have waited to see how the oil prices are behaving before actually raising rates? Or were they too presumptuous that rates will keep going up, inflationary pressure will keep rising? So is there,
I think it goes back to,
there should have been a pause in rate hikes?
I think it partly goes back to what I said earlier, is that central banks, not all central banks were in the same position.
Right.
In that the ECB was neutral, the Bank of England was already restrictive. The Fed was neutral to restrictive.
Right.
So when you're starting from different positions, your central banks themselves are going to have different reaction functions. And I think that's partly what's been playing out in the markets. But markets in general have always reacted quite significantly to oil price moves.
Right.
And underlying that, gas price moves. And again, it also goes back to the institutional memory of the market, in that the ECB in particular was considered late to the game last time around. And therefore it will be quicker this time around. And I think I think Christine Lagarde was it wasn't widely reported, but this whole thing about economic agents changing their reaction functions a lot quicker, reacting a lot quicker this time, even though there isn't any evidence of second round effects yet.
Right.
The ECB is pretty convinced these are coming regardless. The Bank of England is not so convinced. I don't think the Fed's that convinced either. And I think the Bank of England and the Fed are far more likely to stay on hold this year than anything else.
Right. Yeah, I mean, I think the preference of most central bankers was to look through or look beyond this spike in oil back in back in March and April and early May as a temporary energy shock that policymakers should not react to, right? And that was easy to say when the war was, one week, 2 week, 3 weeks old. They started to panic as it entered about the second month, and started talking higher rates. Now oil's come back off, and it's like, yeah, well, I'm not sure where everybody stands now. Like you said, I agree with you. I don't think the U.S. is going to raise rates, here. But anyway, so listen, let's switch topics a little bit. We talked offline briefly before we came on, and you think that this NATO conference that happened earlier in the week is potentially fairly significant for fiscal Europe and perhaps other countries. Explain that for us, will you?
Yeah. So there's usually these NATO conferences make no difference to financial markets, but I did see some contacts of mine were wondering if some of the yield upside that we saw earlier on in the week was partly to do with the amount of deals which were announced. There was clearly quite a bit of appeasement for President Trump going on. I think Mark Rutte was very clearly announcing that 50 billion of defense spending deals that had already been penciled was clearly for President Trump's sake. We are trying to do stuff. I happen to think, whatever I think about some of President Trump's ways, I think he was probably correct on the whole NATO aspect, in that there has been quite a lot of underspend. Even the Obama administration several times had pointed that out. So this is a long-running affair. I think President Trump's clearly got a lot more annoyed than previous administrations, and has been a lot more forceful, and obviously wants to show that he's going to back that up with action as well. But the problem still comes down for some nations down to guns and butter, as the old saying goes. It has been a lot easier for those countries on the front line, such as Poland and the Baltics, to push through large defense spend programs, even if they're at the expense of other programs. Whereas you've got France and the UK, for instance, are really struggling with that debate. The UK still does not have a plan to get to 3.5% of GDP. And that's core defense spend. And don't forget, there is a wider defense spend, which is the infrastructure, which is what they call dual infrastructure usage. So a bridge can be used civilian-wise and military-wise, but the military angle is you can move stuff around a lot quicker. And that's another 1.5% of GDP. So the whole total package is supposed to be about 5% of GDP by 2035, I believe. There's also the changing aspect as well of the composition. 35 billion of that 50 billion was for drone defense. Again, countries have got to who builds this stuff? Presumably the private sector will do the building, but there's several aspects to this. One,
a number of US companies walked away with contracts, Northrop Grumman and the likes of those out of the European defense spend.
Oh yeah,
it was as much of a business summit as a NATO summit. US anyway.
And again, one of the aspects was, can we give? I just think there was clearly some money. Let's shove some money towards US companies. But there's also an aspect that if you look at European defence, it's not able to benefit from economies of scale, whereas the US can. US has maybe one type of truck. In Europe, you've got a whole variety of trucks depending on which country is doing the building. And the only way as well for the private sector companies to actually have the capacity to build all this stuff is it needs long-term government contracts.
Right.
So it's all right saying we're going to chuck a lot of cash at you, But is that going to dry up in 3 years? No one's going to build a massive factory if the whole stuff's going to go away in 3 years. So there needs to be a lot of transparency for investors. If a defense company wants to build another arm to its factory, where does it get the money from? It goes to investors.
Right. Now, does the European spend, does this begin to impact longer term sovereign bond yields, credit spreads? Do you see that? Again, most of these NATOs come and go without any kind of, without even passing mention. Do you see that what's been agreed to here changing the trajectory of long-term interest rates and credit in Europe or the UK?
Again, it depends on the guns versus butter argument. Germany, for instance, has managed to get most of the defense spend outside of its debt brake. On paper you go, okay, that's good, because then it doesn't go into those calculations which limit it, but you still got to get the money from somewhere. So if you are still going to the market to get the money, there's a chance and a risk that this puts upside pressure on real yields, but there's also a lot of fiscal spend runs the risk of putting up some inflationary risk as well. So you could end up with a bit of a double whammy that pushes yields structurally higher whilst all this spend is going on. And then the ECB has noted a few times that this is likely to help support demand in the economy.
Right.
I think the jury's out as to how inflationary that might be. But ultimately, the money's got to come from somewhere. The Eurozone's in a better situation than the UK, for instance, because, again, it's got the current account surplus, which generally, loosely interpreted, it's got a lot of excess savings.
Right. But how will
the UK hasn't.
How will the voting public react to this? Yeah. First of all, the Trump appeasement, is that a good populist move for the politicians? And
I don't think anybody's really cared about the Trump appeasement stuff yet. I think that's likely to come out if all of a sudden you're cutting local services.
Right.
Then that kind of thing starts coming through, I think then. The UK, for instance, still hasn't decided what it's going to do with its spending profile.
Right.
Germany has made it quite clear, because it's made, I think, something like 800 billion was announced earlier on this week.
Right.
The UK is struggling to find the money. There are other nations that are struggling to find the money. And if you have to start cutting what are politically nice but economically poor budgets, I think that's when you start having a problem.
Right. And you're not seeing that yet. But how do you fund yourself? Do you think there will be a lot more government bond issuance to just fund this kind of initiative? You see a lot of supply into the market.
There's potential for a tremendous amount of supply to have to come on the market, because if you can't cut a lot of programs, then you either don't live up to your NATO promises, or you have to go to the market.
Right.
And the capacity in some countries to go to the market for significantly more money isn't necessarily there.
But are the markets already reacting to this? Do you see it's great that you saw this NATO summit as more than what it usually is. Do you think the markets are already pricing in this possibility that there will be a lot more spending in defense, so a lot more borrowing to fund it?
No, is basically the short answer. I think everybody is very, very focused on the Gulf and the implications of the Gulf at the moment.
Right.
The oil price has clearly been the most significant mover this year.
Right.
And this kind of stuff with government and fiscal space, it tends to run in the background and then all of a sudden explode.
Right.
And then all of a sudden people suddenly go, whoa, oh, that's happening.
Right.
Yeah, I mean,
that's been happening for how long?
Yeah, it seems to me that this NATO meeting, the takeaway for me was that people like countries like Canada, all of a sudden realized that this ask for increased NATO spending was not a suggestion. It was a demand. I mean, Mark Carney came out and actually said, no fan of Trump's. He said, Trump's won the argument here. So, I'm wondering if, some of these European countries that have been lagging on their defense spending, thinking that, oh, well, we'll just outlast Trump, or we'll find a way around it, or blah, blah, blah. Is that the realization, like, there's no way out of this, right? We have to, and to your point about the markets not having priced this, I think they've always, the European bond markets have always figured, well, there's probably a way around this or something. But to me, the takeaway is there's no way around this anymore.
Yeah.
Right.
I think it's going to be very difficult. But don't forget, it's not just the US that's got a bit annoyed with the laggards. Other countries have got annoyed with the laggards as well. So there's internal pressure. So it's not just like a US versus the rest here.
Right.
Mark Rutte was very clear as well. You've got to start coming up with a plan to get to where you're supposed to be.
Right.
Yeah. Everybody agreed to this.
Right.
Yeah.
It shouldn't really be negotiable. And yet, a lot of politicians and leaders seem to think it is negotiable. And if you want US help, you're going to have to stump up.
Right. Yeah. But it is a difficult choice to make, right? Like when the economy is not growing as much, there's need for social services or help from the government on different things, on day-to-day life stuff. And then you're talking about war and defense and stuff to spend money on those kind of things rather than the real life situation. It's not going to be an easy choice to make, right? Like, I think, of course, everyone needs to shell up their side of the money to protect themselves, but at what cost? So that's always going to be, that change is going to be always very difficult, I guess. Yeah. It's going to take time.
I think you can soften the blow by spending domestically.
Right. Right.
Which means more money.
Yeah.
Right. So,
but also, as I mentioned earlier, you've got, I don't know how many different types of vehicles across Europe. So you've got this tension between trying to get economies of scale to work to make everything cheaper.
Right.
Against, we've got to spend domestically to provide for the electorate and provide, get a classic fiscal multiplier going.
Right. Well. Yeah, but actually, Bruce, I wanted to ask you, what's the mood like in the US markets on this whole? Is there any impact here at all, or?
No, I don't think so. I think the US market is two things. The U.S. market is one of the. Let me back up. One of the takeaways here was that I was reading about the number of deals that Trump secured for European defense spending.
Right.
He clearly went over there with a strategy like, you guys need to spend more. As it turns out, we have all these wonderful companies that can build you weapons, and thank you very much. So he walks away with that. So it's a net economic positive for the United States. I think that I think probably what's more interesting, or what is of more interest to the American Treasury market and credit markets over here is the new Fed chair coming in, and what he's stated his intention to remake the Fed in various different ways. What does that look like?
But before that, Bruce, one small thing. I just want to, if you could just recap how we started how US Treasury yields were at the start of the year.
Right.
Just to give that backdrop before we talk about, because the new Fed chair is rethinking his stance, or there's a change happening, which is very interesting, and we will get into it. But first, I want to set the backdrop to how did the year start for Treasury yields? What are the expectations on rates, and where are we now?
Well, we came into the year with a broadly disinflationary outlook, where rate cuts were priced into the market to varying degrees. It wasn't as extreme as last year, but there was a couple of rate cuts priced into the market this year. And there was a sort of a broad disinflationary a trend, I guess you would call it, through, in the bond markets. Then the war comes along, upends everything. There was some political fighting in the midst of that. There was some political infighting at the Fed over Trump wanted to fire, he fired Lisa Cook. He wanted to get rid of Jerome Powell. There's this drama at the Fed. And so monetary policy has sort of gotten caught up in that. And, I still think that we're in a broad, disinflationary trend. The Fed was right to say, we want to wait and look through our preferences to look through this oil price shock. I mean, you can make the argument that that an energy shock is actually economically negative. It's not inflationary. If there's no demand, if it's not a demand side issue, then it's not going to be, the inflation won't be durable. And I think that they were right in trying to look beyond that. I'm just wondering, these dissents at the Fed ever since about we need to raise rates. I'm wondering how much of that is performative. Okay. You have a new Fed chair who's come in, obviously picked by the president. President's made no secret of the fact that he wants lower interest rates. Right. And you wonder, these guys standing up there dissenting and talking about, the need to hike rates and how much of that is performative and how much of it is, a genuine concern about inflation.
So it starts the year with hopes of cuts. Then now we are thinking, talking about hikes.
So now we've got, 1.5 hikes priced into the market as oil prices have become elevated from the war. I personally think that's just going to fade away. I mean, you're not going to see any change in rates this year. So I think that that's going to fade away. The economy's doing okay. I mean, it's the last quarter was the last couple of quarters have been somewhat disappointing, right? One handle GDP, and that's not great. The wild card in Fed policy is employment or labor conditions. You see a lot of anecdotal evidence about tech firms laying people off, AI displacing workers, and blah blah blah. But most of the employment metrics have remained fairly positive. There was disappointing data last week. The monthly jobs number missed big time last week. The ADP number was weak. Recurring claims out yesterday was the highest since February. So there are some signs that the labor market is struggling, right? Which would definitely make those Fed hawks who want to hike interest rates take pause. And
it's not a very politically supportive decision as well, right? Like, I don't think Trump will like rates being hiked.
No politician would, right? I mean, ahead of an election, right? No politician's going to want that, but
nor would a real estate man.
No, exactly.
Right, exactly.
What's in his DNA? Zero interest rates.
Yes. So anyway, so I think that was at 30,000 feet, a broad disinflationary, trend was intact as we came into the year, and it's clearly been interrupted. The question is, do we resume that? Do energy flows normalize and we resume that broad disinflationary trend, or not? And we'll see. And again, another big component here is what the new Fed chair's intention to remake the Fed. So, Marcus, what's your take on this fella Kevin Warsh and what he's trying to do, and what do you think that it's kind of going to come out of that?
I think you need to give him a chance. I mean, I think most of the negative press has been more of President Trump's making rather than anything else. In
what way, Mark?
Well, he's been jumping up and down. He wants lower rates, and as I said, as a real
Right.
estate man, of course he wants lower rates. They always
Right.
want lower rates. It's possibly a personal preference. He obviously wants lower rates because that looks good to the electorate as well.
Right.
But the screaming and shouting about that, and I want to get rid of this person and that person because they're not doing my bidding. That is what has clouded the whole environment around Kevin Warsh.
Right. Right.
As I say, I don't understand the hullabaloo around getting rid of forward guidance. We were talking yesterday. 20 years ago, no one cared about it. 25 years ago, everybody was dealing without forward guidance.
So this is guidance on what the central bank thinks on where interest rates should be or what their targets are. Yeah.
Yeah, so forward guidance. It covers a multitude of sins.
Right.
We had the state contingent forward guidance after the great financial crisis. I think both the US and the UK had, they called it a threshold because they didn't call it a target, but the markets treated it as a target, and this was a problem.
Right.
As Mark Carney found out, when they set the unemployment rate as a threshold, and once it got to that, he was quite clear, and he said, "We'll think about talking about cutting rates, hiking rates,"
Right.
and the market took it as, "Oh, well, you're definitely going to hike if that happens."
Yeah.
So, of course, when it fell through,
Right.
and they didn't hike, there was quite a huge media circus around it.
Right.
And there's quite a few people got caught offside in the markets on that. And that, in the end, led to that now classic quote of being called by a member of the British Parliament the unreliable boyfriend, which, again, I think that betrayed the lack of understanding of monetary policy on behalf of a politician, which I know won't come as a surprise.
Right.
So the whole thing around forward guidance, Christine Lagarde put it at Sintra, markets are just going to have to work a little harder.
Right.
Markets don't need their hands. They're big people. They're big boys and girls. They don't need their hands being held.
Right.
Yeah. I don't want to date myself, but back in the day, the Fed would do an operation at 11:45 every day.
Yeah.
Repo or reverse repo operation. No statement, no nothing.
Yeah.
You had to interpret by the size of the operation or the direction of the operation what they meant or what they were, where they were going. There was no hand holding.
No.
So
why do you think they went to hand holding? If that was working previously, or was it not working? That's why you had to go to hand holding, or is it like political decision to ensure markets keep going up?
Well, they wanted to suppress rates.
Right.
That was the basic thing. It provides some certainty. Particularly after the great financial crisis, classic case,
right.
Interest rates were already at bottom. And the general thought process was interest rates are definitely going to go back up again. And as it turns out, they didn't go back up again for a long, long period of time. But monetary policy was there at its zero lower bound. It had done a bunch of QE as well, and investment and consumption were not picking up as expected or as desired.
Right.
So in order to try and get people spending, get businesses investing, well, we're not going to raise interest rates. You've got some certainty, and particularly if we give you a particular thing to look at.
Right.
But of course, it was a threshold, not a target. And the targets, and they were treated as targets. But it still actually didn't make much difference because they didn't go and react to it anyway when they went through, because the economies were still so weak.
Yeah, you remember the old statement, we're not even thinking of raising interest rates, right?
Right.
Yeah.
I mean, interest rates were already at zero, and they were trying to figure out how to ease beyond zero without the absurdity of negative interest rates, right? So the QE, right, was one, and the other was this forward guidance saying
actually,
rates are going to be at zero.
Before you answer that,
for the rest of your life.
I wanted to ask
so,
is
don't worry
central
about it.
banks, in some sense, they kind of fuel this this whole
they had priced in hikes, one or two hikes early in the year.
I dare you,
And then there was
I
these
can't think of
hikes.
any other word now,
Like,
but
do you
this
think the
bubble,
central bank should have waited
this
to see how the oil prices
two-decade
are
bubble of
behaving
markets just
before
going
actually
one way
raising
up,
rates? Or
and there's
or
no
were
real
they too
correction. There's
presumptuous
been
that rates will keep
crisis
going up,
in
inflation
between,
pressure will
but
keep
nothing has changed. But do you think
rising?
this
So
policy
do you think there should have been a
of a
pause in
target
rate hike?
and letting the market know their gameplay way more than they should have, or not the way they did before, did that help create this whole investment mindset
Yeah.
to keep buying all the time?
Yeah. It supported risk assets, but that was part of the point as well,
Right.
was to support risk assets, keep financial conditions easy,
Right.
which was the ultimate aim of the whole package of monetary policy over that period. And in the end, it took something quite extraordinary with COVID to
Right.
start knocking these central banks out of their comfort zone, and the markets a little bit out of their comfort zone.
So this is a good way to get into. So the new Fed chief wants to change things, right? Like or at least he's talking about not doing what his predecessors or recent predecessors were doing, right? Like, so
Yep.
take us through that.
Yeah. I mean, as I said already, I don't really understand why getting rid of forward guidance is a big problem.
Right.
I do know some people, for instance, have called the dot plot utterly useless as a guide anyway. And so that, I suspect, I mean, Kevin Warsh decided not to put a dot in. I think that's a pretty indicative statement in itself.
Right.
I'm not entirely sure what use the dot plot has other than us having something to talk about. It
Right.
might give people an idea of what this fuzzy concept of neutral is, but that's about it really. Trying to tell somebody what the interest rate is going to be in 2 years' time,
Right.
that fell flat on its face. What were they saying in 2019?
Right.
And if you put too much certainty, people also make bad decisions.
Right.
So we might end up with a little bit more risk, but that gives more opportunity as well.
Right.
And the other aspect is, of course, the balance sheet, which I think he's going to have. Again, I think it's a good idea, but I think he's going to have a harder time doing that. But I don't think that will be as contentious as regulation.
Right.
I think the regulation aspect here is going to be a very, very hard public sell. I think the banks will be quite happy, I suspect.
Right.
But a hard public sell, if you've got to start explaining to people the intricacies of easier financial conditions and there'll be potentially more liquidity for lending,
Right.
you're going to have a whole bunch of people suddenly go, but hang on, that sounds like the lead up to the great financial crisis.
Right.
And that's going to be the hardest
Warsh is talking about deregulation, right? Like, I think there's talk about loosening bank regulations recently, right?
Yeah.
And you think he will continue that, yeah? He'll keep bank regulations easier, not tighten
I
them.
think there will be an attempt, at the very least, to loosen them. And, there will probably be some loosening here and there.
Right.
But as we've spoken about, I think it's a question of where does that liquidity end up going?
Right.
If it goes into the real economy, people will be happy about that. If it suddenly starts finding itself into the exotic corners of the financial markets and starting to create some bubbles in areas there's very few people who really understand, which is kind of what happened with credit default swaps.
Right.
It was a very young market, which ended up helping to blow up quite a few banks.
Right.
If the liquidity starts going down that route, that's going to be a very hard sell. So what guardrails are there going to be to stop that? And then how does he sell that to the banking community as well?
Right. And how do you monitor it? How do you monitor it?
How do you monitor it? Yeah. I mean, is it going to be a give with one hand and take a bit with the other?
Right.
Have
On
you?
the- yeah, sorry.
I haven't had I haven't had. Kevin, they announced the personnel appointments to these committees that he formed.
I've seen a few, yeah.
To remake the Fed. I just saw the headlines yesterday. I haven't had a chance to actually look to see. I mean, are there any takes here on, this guy got appointed to here and that this has potential policy implications in certain direction, or is there any takeaway that
He's
you've
got
seen?
some highly respected former central bank chiefs in there.
Okay.
You think, Mervyn
King, right?
Yeah.
Yeah.
Lord King.
Yeah.
I mean, he was a bit of a victim in this country in some respects because he believed that central bankers always guided a little bit when they were talking anyway, so you didn't need this explicit forward guidance.
Right.
Yeah,
he's on the committee for communication.
Yeah. And that in itself, well, I think it's a bit of a statement that what we know what Warsh is trying to do, get rid of forward guidance, but that in itself is quite an indication that the Bank of England last year had the Bernanke review.
Right.
Bernanke, as far as I'm aware, is nowhere near what Warsh is trying to do.
Right. Yeah.
And the Powell Fed is pretty much in the mold of the Bernanke Fed and the Yellen Fed as well.
Yep.
So there seems to be a wholesale pullback of a long period. And this is where you start to get a sense of how much he is trying to change.
Right. I mean, I look at one of the benchmarks that I look at for that, or his success, or perhaps perceived success, is the dollar. The dollar had, since the Fed meeting or since his appointment, the dollar has broadly been firming. And that to me, that's of interest. It will be a sort of a gauge of market sentiment as to whether he's making progress on these. I wrote about it at the time. I think what he's trying to do is end this era of easy money where his predecessors have been willing to accept above target inflation for more than 5 years now. To keep financial conditions loose when they need it. I mean, again, we go back to Shanks. We were talking about this the other day, right?
Right.
The Fed comes out and talks a tough game about, oh yes, we're raising interest rates and blah, 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 blah. And then Silicon Valley Bank fails, and within 24 hours,
Right.
they just threw money at the thing and bailed everybody out. It's like, yeah, you guys aren't serious about any of this stuff. So
there is like no downside, right? Or the downside is protected. Because even when there was regional, and we had a guest earlier who also mentioned this, right? About how unsecured depositors were made whole, right? Like, so it's like, what should the market read from that? Is it that, there is no downside, or there is someone protecting it and we can keep buying whatever, keep taking risk, because at some point or the other, someone is going to rescue if things go, bad.
Well,
and
it's another version of the Fed put.
Yeah.
Yes.
That's kind of what's been going on. And it's a question is Warsh actually going to reform it to the extent that it just completely takes away the Fed put?
So on that note, actually, one of the things is like what Bruce was mentioning, like the tightening of financial conditions is what he is looking at, which is that balance sheet reduction, right? Is that, what do you make of that? Because he's talking about reducing the balance sheet. How does that impact everything? We are not seeing any impact on liquidity or markets reacting to a possible tightening of financial conditions. Is that correct? Is that, like, people are not, although they're inferring that there would be balance sheet reduction by the Fed, which would tighten financial conditions, but the markets are not reacting to it yet.
No, yeah, right. You're right about that. I'm sorry, Marcus, but the only noticeable impact has been, a firming of the dollar. Now it hasn't gone on a tear, but it's definitely firming up. So it's perhaps seeing, tighter financial conditions ahead. But you look at any other market. I'm hard pressed to see how any other market is expecting financial conditions to tighten. You know what I mean? I mean, we're still sort of in that AI, bubble-ish narrative in the market. What do you reckon, Marcus? Marcus? Is that
Yeah, I don't think the market. Well, I think the markets actually want to know what Warsh will actually do with the balance sheet, because most of the stuff you're seeing is it's going to take a long time, and if it's a slow dribble, you're not going to see massive changes in financial conditions. You might look back 3 or 4 years down the line and go, oh yeah, well, we have seen something. But if you've got a lot of other things moving parts at the same time, the whole policy package could still keep financial conditions at a level that is appropriate, or the Fed sees as appropriate for the state of the economy.
And then you are like, if you're tightening financial conditions, you have banks, regulations being loosened, which creates more liquidity, lending liquidity, right? And more demand or more capacity among the banks to buy the Fed's balance sheet as they are unwinding it, right?
Yeah, so they can offset.
There is like multiple factors going on there. And then if you're tightening financial conditions, is there scope to cut rates? And if you're not able to cut rates,
well, I think that's the theory anyway.
Yeah,
we'll tighten financial conditions, and it will be broadly disinflationary, and that will allow us to naturally lower interest rates in the future.
Oh, right.
That's the theory. So we'll see if it plays out that way. But
so, is there like a midpoint he's going to reach? Or is this all a bit of posturing, you think? Because there are some people who are saying he's saying all the right things, but he might not do all of it. Is that right? Is that the way you guys look at it?
But it's not, don't forget, it's not one person who decides all this.
Right.
He can set a philosophy and a theory, but if the rest of the Fed turn around and basically go, well, you're a crankpot, then he's going to struggle to get any of this through, because it would damage the credibility of the Fed if there's such extremes. You look at, did anybody take Stephen Mirren seriously? Nothing against Stephen Mirren, but I don't think the market. I mean, I was talking to somebody who basically said that Stephen Mirren's 50 basis point cut was so out there that nobody paid any attention to it.
Right. Yeah.
So he's going to have to find some middle road to thread through the rest of the FOMC. So we may find this kind of give with one hand and take with the other. And so we could look back and say for 3 years' time, say financial conditions are exactly the same because of what they've done. But also, it's not going to be tomorrow that all this stuff can do. You can't just say today, I'm going to cut banking regulations and it gets done tomorrow.
Right. Yeah.
There's a lot of to and fro within the banking industry itself, within the Fed, and the politicians will have their say as well. So we could end up having this debate, I don't know, for another 18 months or so.
So
but there can be an immediate impact of eliminating forward guidance, right, Marcus? I mean,
that's the easiest one to deal with.
That's the easy one, right? I mean, if you eliminate. Yeah, you eliminate guidance. People have to, people have to sort of, assess risk. Like Lagarde said, work a little harder, assess risk a little better, accept a little bit higher volatility, perhaps. So, yeah, we'll see what happens. But you're dead right. I mean, this other stuff takes forever.
So what is like? I wanted to. We are running out of time, but. Like what are the expectations of interest rates by the end of the year? Where do you guys see it? Do you see hikes or cuts, hold? So Marcus, start with the Eurozone. Where do you see things?
My suspicion is that under current circumstances, the ECB is hell bent on hiking at least once more.
Oh,
probably September. They are. Even looking at the minutes yesterday, they were very, very clear on their reasoning, and they produced an extra scenario called the milder scenario, and this was what gave them. This was a robust decision, because even the mild scenario says our forecasts suggest inflation is going to be here, therefore we have to hike. And they've already talked that no matter what happens to the oil price now, second round effects are going to be problematic. So I can't see, and there's going to have to be quite a change in tone over, they're meeting 2 weeks actually. That's going to be an interesting press conference. They don't have any new forecasts out in 2 weeks. The Bank of England, I think, is going to sit on its hands, but it's already restrictive.
Right.
And I think that natural restrictiveness will allow it to not do anything. The committee is split, and the chief economist seems to be gunning for a hike. But I don't think the majority, certainly not now, they are looking at the downside growth risks. There's a deteriorating labour market. Growth isn't particularly great. So I'd be very, very surprised if, under current circumstances, they hike this year. I don't think they'll cut, though.
And what do you think is the impact on yields, like short-term versus long-term? Where do you see markets? How are markets already pricing this?
The markets again, they're just reacting to the oil price at the moment.
That's it. Okay.
As soon as the oil price moves, all of a sudden, I mean, you looked at the Sonia and Euribor strips this week. I mean, it's they're all over the place. I don't, the reaction to the oil price is the driving force of rate expectations at the moment.
Yeah.
Great. And Bruce, US, where do you see it?
Yeah, I think that there's enough uncertainty because the Fed is a dual mandate central bank. There's enough uncertainty in the labor market that's going to keep the Fed hawks, or those guys that want to raise rates. I think it's going to keep them contained. So in other words, you may still have dissents and a few dissents, but I don't think there'll be enough votes. The bar for raising rates is pretty high in my estimation. So
right.
It's
going to be hold.
Yeah, I just think like I said earlier, I just think there's enough. Just when you think the labor conditions have stabilized, or they're as they were somewhat weak early in the year, and then they seem to rebound and stabilize in the spring, and then you get a couple of dodgy numbers last week, and it's that uncertainty, I think, is going to keep the hawks from getting any legs here, and I think that probably, I don't see any compelling reason for the Fed to change rates.
Right. And the yields, like Treasury yields, are they pricing any of this in already, or?
Yeah, I mean, slowly. I mean, the curve has been flattening since oil prices have come down, which, again, I think the market, and you look at the demand in the corporate bond markets, right? It's massive. I mean, we had a 10 and 30-year Treasury auctions the last 2 days that just were stellar. They came through where the market was trading in before the auction. So in my mind, there's still a tremendous demand for yield, right? And you see that every day, right, in the credit markets, right, Shanks?
Right, absolutely, yeah.
I mean, you've had a couple of big weeks here recently in terms of issuance,
right?
And these books are just continue to be well covered, and there's a demand for yield. Because I think it goes back to what I said early in the podcast, that there's a lot of investors see us in a broadly sort of disinflationary trend, the economy, and that they'll take opportunities such as a short-term spike in oil prices to take advantage of that and lock in yields. I mean, Shanks, we had a guest on earlier in our podcast series that said this for credit. For corporate bond investors, Marcus, you'll find this funny, right? Remember the Liberation Day when Trump announced all that, and the markets blew out and everything else. Mm-hmm. Well, anyway, it created an incredible buying opportunity for not only stocks but for corporate bonds.
Right.
But most of the investors we talked to said it happened so fast that we couldn't do anything. Like we couldn't. Yeah. And it just turned out to be an opportunity lost, right, to lock in higher yields. So their attitude is very much, when we see these this pop in the oil price or whatever, we see it as an opportunity, not something to be run away from.
Yeah.
So
Yeah.
anyway.
Absolutely. Okay. And because, every time the oil price has popped, usually those are no-go days in credit, but we have seen tons of issuance.
What, like this
It
week,
is-
right? You would think that the hostilities this week would have scared off investors,
Nah.
right? But you had what? You blew through the estimates already, right?
Yeah,
this
because
week?
the Amazon did a $25
Amazon did a
billion
big deal,
deal,
right.
but it's like over 50 billion in 1 week
Right.
on a week when usually it should have triggered an
It
opposite.
would have been easy to walk away this week. Right.
Yeah, but they didn't. It's
didn't.
kind of,
So,
it's
yeah.
amazing. But anyway, guys, thank you very much. That's all we have time for. But thank you very much, Marcus, for doing this.
Pleasure.
And thank you all for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts. And tune in next week when we dig into the latest credit events. And we have an interesting guest as well next week. And if you want to receive real-time reports and market data, you can request a free trial of IGM services. The link is in the show notes. Thank you again, Marcus. And
Thanks, Marcus.
Pleasure. No worries. Have a good weekend, guys.
have a
Good-
nice
good-
weekend, guys.
Good
Take care.
stuff, buddy. Thanks.
Thank you. Thank you.